Alright, dear students, now we are going to revise one of the most important standard of the F7 exam, which is revenue from the contracts with customer, and the number of the standard is IFRS 15. The first thing you need to understand is the difference between the income and the revenue, because this concept can be tested as part of the objective test question or in the final account adjustment. And we have seen in the past that this concept has been tested both in the objective test question and in the final account adjustments. So income is the inflow of the economic benefit. It can be anything. For example, it can be interest income, it can be the rental income. But when you talk about the revenue, revenue is the income from the ordinary course of business. Income arising in the course of entities' ordinary activities. For example, my business is to sell the cars. So the income from the sale of those cars should be recognized as the revenue in the statement of profit and loss. But for example, if I am doing something other than ordinary activities, for example, if I'm helping someone to buy some goods, but I'm keeping the commission, that commission, or for example, if I'm acting as an agent for someone, that agency fee should not be recognized as the revenue. In fact, that is the income. Similarly, the sale from the proceeds of the non-current asset, similarly, all other incomes like rental income, interest income cannot be recognized as the revenue. But say, for example, if I am the property agent, now agency is my ordinary course of business. In that case, the agency fee is the revenue. But other than that, for example, if I am having some commissions, I am acting as an agent, but that is not my ordinary activity, that cannot be classified as the revenue. So in the exam, there may be an adjustment that they have told you that either the proceeds from the sale of the non-current asset, or for example, regarding the agency fee or the commissions, that tell you that these are made part of the revenue, so you have to reverse it from the revenue and you should record that thing as the income rather than the revenue. Now IFRS 15 discuss how to record the revenue. It actually tells you the 5-step model, which is COPAR, to record the revenue. In addition to this, it also covers the construction contracts. Although the construction contracts have the same criteria of this 5-step model, but we are going to discuss that thing separately, because in the F7 exam you have the MCQs related to the construction contracts. So the 5-step model is COPAR. C stands for there should be a contract between two parties. And when you talk about the contract, that means there should be a legally binding agreement between two parties. The second important point, the second stage or the second step that you need to understand is identifying separate performance obligation within a contract. Now this is a concept that is usually tested in the final account adjustment or in the objective test question as well. Say for example, I am going to buy a car from a car company, say for example Toyota. They will be giving me a car. In addition to the car, they will be giving me 3-year service. 3-year service, I can take one annual service, and plus say for example the warranty for some specific parts. Now that means within a contract there are 3 performance obligations. The first one is the car, the second one is the 3-year service, and the third one is actually the warranty. And these 3 obligations will be satisfied differently. Like for example, they will be immediately giving you the car, but regarding the services, these are the annual services and you cannot get all 3-year service at once. Obviously, it is impossible to get all 3-year service at once. So that means this performance obligation will be satisfied differently from the car. Even the third one, which is the warranty, will be satisfied differently, because you can claim the warranty only if some PCs or some particular components of that asset is not working well. Then you will be able to claim those things. If everything is going fine within a certain time frame, for example, they have given you a 1 year warranty, that within 1 year, if something is happening wrong, you can bring that thing to us and we are going to repair it or replace it. If 1 year has passed, now there will be no performance obligation related to the warranty. So that means the three performance obligation will be satisfied differently. You can take another example. I am going to buy a mobile phone from a telecommunication company. They will be giving me a mobile phone. They will be giving me a service which is related to the connection. And then they may give me, for example, a portable Wi-Fi device. Now I am going to enter in a contract with them, but this contract contains three performance obligations, three different performance obligations. They will be giving me the mobile phone. They're also giving me the service, which includes the internet and messages, call service, and then portable Wi-Fi device. Now within this contract, the mobile is the good that will be immediately provided. The portable Wi-Fi device is also the good that will be immediately provided. But regarding this service, say for example, it's a 2 year service, then this service will be provided over the time. They cannot give me the 2 year service at once. So the second step is to identify separate performance obligations within a contract. And this is something very important. We'll be doing an objective test question related to that in a while. Now the third one is determining the transaction price. When you are entering into a contract, the contract is going to have a transaction price. It may have the fixed consideration, it may have the variable consideration, it may have the non-cash considerations. The fourth thing is allocating the transaction price to the performance obligation in a contract. Now again, this is something very important. In the step number 2, you have identified different performance obligation like car, 3 year service warranty. In the third step, you have determined the whole transaction price, and that transaction price includes all the components. But in the fourth step, you are going to split that transaction price to different performance obligation. What is the price you are going to allocate to car? What is the price you are going to allocate to a 3 year service? And what is the price you are going to allocate to the warranty? Now the basic principle is the stand-alone price. We usually allocate the transaction price to different performance obligation based on the stand-alone price principle. What if the company is only selling the car? What if the company is only providing the service? What is the value of the car if they are only providing the car in isolation? What if only they are providing the service? What is the cost of that service? So based on the standalone prices, we are going to allocate the transaction price. And if there is any discount on the bundle, that means overall, that will be applied to all the performance obligation in the contract. The last thing, which is the fifth step, is the recognition of the revenue when the performance obligation is satisfied. That means the company has done their job. Now this job either will be done at point in time, like for example, you look at the above examples, they gave you the mobile immediately. That means their performance obligation is satisfied at point in time. Similarly, they have given you the car immediately. Their performance obligation is satisfied at point in time. But the second thing is over the time. And again, you look at the above example, they will be providing you the service over the time. They will be giving you the 3 year service over the time. So the revenue related to at point in time should be recorded immediately. The revenue related to the services which are yet to be provided is going to be recorded when the performance obligations are satisfied. So this is the principle that you need to remember. Now, we'll be talking about the construction contracts. And in the construction contract, there will be two terms used. One is the output method and the other one is the input method. Now the construction contracts are the long-term contract. Like say for example, you are entering into a contract to construct a building. It may take for example 2 years, or for example you're going to construct a bridge which can take 3 years, or for example you are building a stadium which can take even 4 years. So how the revenue related to those contracts should be recorded? If we are recording that revenue immediately, even this is the incorrect accounting. If we are straight away splitting the revenue over the 4 years, that is again the incorrect accounting, because you may not have provided the equal services. You may not have done the equal work. If you are recording the revenue at the end of the contract, even that is not the correct accounting. So what is the correct accounting then? The revenue related to construction contracts should be recorded based on the stage of completion. And to determine the stage of completion, to determine the progress, that how much the work entity has done, there are two methods for it. One is the output method. It is also known as the work certified method. And the other one is the input method, which is also known as the cost method. So these are the methods we are going to use for calculating the progress. Now, whenever you are having the construction contract question in the exam, remember, this is even tested in the objective test question, and you will be having an adjustment in the final account question. So these are the steps that you need to know if you are calculating the revenue, profit, loss, the figure related to statement of financial position regarding the construction contracts. So the first step is to calculate whether the contract is generating profit or loss. If the contract is generating loss, loss should be immediately recognized in full, considering the prudence concept. And if there is a profit, it is going to be recognized based on the stage of completion. That means you cannot record the profit immediately, but the loss will be immediately recognized. The second step is to measure the stage of completion, either through cost method or work certified method. How much percentage, how much in terms of percentage the work is completed. So there are two methods, input method or the output method. The third step is going to be calculate the revenue, cost of sales and profit to be included in the statement of profit or loss. And this figure will be actually calculated by using the percentage which we have calculated from the step number 2. The last thing will be calculate the contract asset and liability, and this makes the sense. If you have provided more work and received less payment, then that should be recognized as an asset. If you have done less work but have received more payment, then this should be recorded as the liability. So now you have the workings right in front of you. Working number 1, you have to calculate whether the contract is generating the profit or loss. So how you are going to do it? Take the full price of the contract. Contract revenue means contract price. Then you are going to deduct the cost from it. Cost to date, that means the cost which has been spent till now. And then there will be, for example, further cost to complete. These two will be deducted to calculate the profit or the loss. The second step is to determine the stage of completion. So the cost method is cost to date divide by total cost. Like for example, if you have spent 25 cost till now and total is the 100, multiply by 100, that means 25% work has been completed. Or it can be a work certified method. Work certified means the work you have done, how much value it is. How much work you have done in terms of the value. Divide by total price, multiply by 100. So in the second step, you will be calculating the stage of completion. In the third step, you will be calculating the figures related to the statement of profit or loss, which is revenue. Now what you're going to do is take the price, total price, multiply by the percentage. And you take the total profit, which have been calculated from step number 1, working number 1, multiply by the percentage. The cost of sales will be actually a balancing figure. And the working number 4, cost to date plus profit to date. Technically, when you add cost plus profit, it gives you revenue to date. And this is the revenue which you have earned. This is the revenue earned, not received. And then you compare it with the payment from the customer. This is actually the received payment. So as I have told you earlier, if you have done less work and you have received more payment, that will be recorded as the liability, contract liability. And if you have done more work but you have received less payment, then that should be recognized as an asset. So these are the 4 steps you need to know if you have the question in the exam related to the construction contracts. So one figure will be recorded in the statement of financial position. One figure related to the revenue and profit will be recorded. Cost of sale will be recorded in the statement of profit or loss. The second step is to determine the stage of completion. And the working number 1 is to calculate the total contract profit and loss. These are the steps 1, 2, 3, 4. Remember one thing, that you have to remember this 5-step model, which is contract, first one, and this should be in the sequence because you may have an objective test question which asks you to define the sequence. So remember this mnemonic or the acronym COPPER. Contract, identifying different performance obligations, and then determining the transaction price, allocation and recognition. Remember, in the allocation, we are going to use the principle of the standalone price, and any discount will be applied on all the components of the contract. In the recognition, we can only record the revenue regarding which the performance obligation has been satisfied. So either it is going to be at point in time, so you can record the revenue immediately, or over the time. And when you have over the time principle, that means you are yet to provide those services, you are yet to fulfill the obligation. So that cannot be recorded as the revenue. Let me tell you one more thing. Say, for example, you have received the revenue in advance. So that will be treated as the deferred income received in advance. So you are going to record that thing as a liability. Just like the principle of the government grant. For example, you have received the cash, debit cash, credit liability. And when you perform your obligation, you will de-recognize the liability and you will record that thing as the revenue. So one more thing which is important for the objective test questions is that you need to know the difference between the income and the revenue. All right, now we are going to do the objective test questions related to IFRS 15. So the first question, question number 1, Mango sold an item of maturing inventory to a bank on 1st January 20x3 for 5 lakh. At this stage, the inventory had cost 2 lakh to produce, but had a fair value of 900,000. Now from the figures you can see that there is something unusual going on, as the fair value of the inventory is 900,000, 9 lakh. Why the company may be selling it on the 5 lakh, which was expected to increase over the next 3 years. At the end of the 3 years, Mango have the option to repurchase the inventory at 6,65,500, giving an effective interest rate of the 10%. So from the transaction we can see that in fact, in substance, this is a loan arrangement. In fact, they are securing their inventory as a collateral and they are taking a loan. 900,000 is the fair value of the inventory, and they are selling at 500,000, and they can repurchase the inventory within 3 year time by the end of the 3 years, and they will be paying 6,65,500. So that means the control has not been transferred, and therefore no revenue can be recorded. In substance, they are taking the loan of 500,000 multiplied by 10%, which is 50,000 for the first year. What item should be recorded in the statement of profit or loss for the year ended 31st December 2023? Can we record the revenue? No, we cannot record the revenue because the control has not been transferred. Can we record the profit? No, we cannot record the profit because this is not a disposal. The control has not been transferred, and this is in fact a loan arrangement. The deferred income is actually the liability and recorded in the statement of financial position. They are asking us regarding the statement of profit or loss. What we can record is the finance cost because we have taken the loan of 500,000 and 10% is the interest rate. So D is the correct option. Now we have the question number 2. Again, that is a very important question related to the concept of the revenue. Repro has prepared its draft financial statements for the year ended 30th September 20x4. It has included the following transactions in revenue at the amounts stated below. Which of these has been correctly included in the revenue according to IFRS 15, revenue from contracts with the customer? Agency sales of 2,50,000, on which Repro is entitled to a commission of 10%. So if they are only entitled to a commission of 10%, they can only record 10% as an agent. The principal will be recording the full 2,50,000. So this is the incorrect recognition of the revenue. As an agent, you can only record the commission and not the amount which is full. It should be recorded by the principal. Sale proceeds of 20,000 from the motor vehicles. So revenue is the income from the ordinary course of business. So B option is not the correct option. Sale of 1,50,000 on 30th September 20x4. The amount invoiced to and received from the customer was 1,80,000. So if the amount is 1,80,000, why have they recorded 150,000? We have to read further, which includes 30,000 for ongoing services, work to be done by Repro over the next 2 years. That means there were 2 performance obligations. The first one is the goods, which is 150, and the next one is the services of 30 which are yet to be provided. So recording the 150 is the correct treatment. So C is the right option. But we'll be discussing D as well. Sales of 200,000 on 1st October 20x3 to an established customer who will make full payment on 30th September 20x5, which is after 2 years. Repro has a cost of capital of 10%. Remember one thing, that IFRS 15 describes a financing component. And financing component is part of the transaction cost. That if the revenue will be received at some point in future, then the revenue should be recorded at the present value. Present value equals to future value 1 plus r raised to power minus n. They need to record the present value of 200,000 instead of full 200,000. So D is also the incorrect option. Now the question number 3, which is very, very important as it is related to the construction contract. Ling entered into a contract to construct an asset for the customer on 1st January 20x4, which is expected to last 24 months. The construction contract has the issue because it is more than 1 year. Otherwise, if it is 1 year or less, it can be immediately recorded within the current year financial statement. The accounting issue is due to the long-term contract. The agreed price for the contract is 5 million. Now, do you remember the steps? In the step number one, we have to calculate whether the contract is making the profit or the loss. In the step number two, we need to calculate the stage of completion. In the step number three, we need to record the figures in the statement of profit or loss, which includes revenue, cost of sales, and profits. In the step number four, we need a figure for statement of financial position, which is a contract asset or the liability. Now let's see what this question is demanding us. At 30th September 20x4, the cost incurred on the contract were 1.6 million. An estimated remaining cost, that means further cost to complete, were 2.4 million. On 20th September, Ling received a payment from the customer of 1.8 million, which was equal to the full amount billed. Ling calculates contract progress using the output method on the basis of the amount billed compared to the contract price. What amount would be reported as a contract asset in the Ling statement of financial position? That means they're asking us for the step number four. So to reach the step number four, we have to do all those steps. Right? Okay, step number one. What is the contract price? 5 million. What is the cost to date? 1.6 million. What is the further cost? 2.4 million. So let's see whether the contract generates the profit or loss. Let me use my calculator. 5 minus 1.6 minus 2.4. It is 1. Okay, it is making the profit. Ling calculates the contract progress using the output method. What is the output method? So output method is work certified to date divided by the contract price. So that means 1.8 divided by the contract price, which is 5. So 1.8 divided by 5, it gives you 36%. Now the step number 3. What is the total revenue? 5 million is the total revenue and 3.6%, 0.36. So 5 multiplied 0.36 is 1.8 is the revenue that should be recorded. And the profit is 1 into how much percentage? 0.36. So 1 multiplied by 0.36. So 0.36 is the profit that should be recorded. And the difference between 1.8 and 0.36 will be the cost of sales. That is actually 1.6. All right. Now the step number 4. The step number 4 is cost to date, which is 1.6, profit to date, which is 0.36, less billed amount, which is 1.8. Now see, 1.6 plus 0.36 minus 1.8. So 0.16. 0.16 is the contract asset that will be recorded because we have done more work but have received less payment. So 0.16 will be recorded in the statement of financial position as a contract asset. Question number 4. CN started a 3-year contract to build a new university campus on 1st April 2004. The contract had a fixed price of 90 million. CN will satisfy the performance obligation over the time. CN incurred cost to 31st March 20x5 of 77 million and estimated further cost of 33 million would need to be spent to complete a contract. CN measures the progress of the contract using the work completed compared to a contract price. At 31st March 20x5, a surveyor valued the work completed to date at 63 million. Select the correct amounts to be shown in the revenue and the cost of sales in the statement of profit or loss for the year ended 31st March 2025. Now that means the step number 1 is the contract profit or loss. Step number 2 is the stage of completion. Step number 3 is the statement of profit or loss. So first of all, we have to see whether this contract will be making profit or loss. Step number 1. Contract price is 90. Cost to date, CN incurred cost to 31st March is 77, and further cost will be 33. So 90 minus 77 minus 33. Let's see. 90 minus 77 minus 33. Okay, it is making a loss of 20 million. It is a making of the loss of the 20 million. Now we know the loss should be immediately recognized. Loss should be immediately recognized. Okay, now we need to measure the stage of completion. Uh, okay, a work certified method should be used, which is 63 million is the work certified, and 90 million is the contract price multiplied by 100. Let's see what we got. What we get: 63 divided by 90 into 100. So that is 70%. The contract has been completed 70%. Now we got the step number 3, which is revenue, cost of sales, and now we have the loss. Loss should be immediately booked. How much is the loss? 20 million is the loss that should be immediately recognized. Now revenue is 90 is the total. 70% has been completed. So 90 into 70%. That is 63. 63 is the revenue. Now we can calculate cost as a balancing figure. So the cost of sale as a balancing figure is 83. So select the correct amounts to be shown in the revenue and cost of sales. So in the revenue there should be 63 million. In the cost of sales there will be 83 million because the loss should be immediately recognized. Okay, now we have the question number 5, again another concept. Lockheed sells machines and also offers installations and technical support services. The individual selling prices of each product are shown below. That means the standalone price. Sale price of goods 75. If the just provide installation 30, 1-year service 45. Lockheed sold a machine on 1st May 20x1, charging a reduced price of 100, including installation and 1-year service. Lockheed only offered discounts when customer purchase a package, that means a bundle. According to IFRS 15 revenue from contracts with customers, how much Lockheed record in the revenue for the year ended 31st December 20x1? When did they enter into the contract? Okay, 1st May 20x1. Right. So first of all, we have to total this amount. Okay, what is the total of the standalone price? 75 plus 30 plus 45 is 150. And 100 is the discounted price. Full price is 150. Now multiply by 75 to calculate the discounted price. Again, 100 divide by 150 multiply by 30. That means discount should be applied to all the components within a contract, all the performance obligation. 100 divide by 150 into 45. So let's see what are the discounted prices. 100 divide by 150 into 75. So it's 50. All right, now we need to see multiply by 30. It's 20 and the remaining will be 30. So this is how we calculate the 100 transaction price. Now, the bundle includes the sale price of goods, installation. Okay, that service will be provided at point in time. And service is to be provided over the time. They have ask what revenue should be recorded for 31st December. So we can record 50 because the obligation will be satisfied. We can record 20 because installation will be done. But we cannot record full 30. We'll be doing it months by 12. So from May to December, these are the 8 months. Okay, so 30 into 8 divide by 12. It is 20. So 50 plus 20 plus 20, that means 90 should be recorded in the revenue. Okay, now we have the easiest question. Place the following steps for recognizing revenue in accordance with IFRS 15. So we know COPAR. So first of all, there should be a contract. That means identifying a contract. Then performance obligations. Then determining the transaction price, which is fine. Then allocate the transaction price. And then the last step will be recognition of the revenue. Okay, in the computer-based exam, you just need to pick and drop in the correct order. Question number 7. Malik is a construction business recognizing progress based on work certified as the proportion of the total contract revenue. So that means the output method. Malik will satisfy the performance obligation over the time. The following information relates to one of its long-term contracts at 31st May 2004, Malik's year end. We have the contract price, we have cost to date, we have further cost, we have invoice to customer, work certified to date. In the year to 31st May 2003, Malik had recognized revenue of 60,000 and profit of 15,000 in respect of this contract. What should appear in the Malik statement of profit or loss in respect of this contract? What profit? So we need to calculate the profit. Okay, so the first step is the contract price, which is 200,000, minus cost to date, which is 130,000, minus further cost, which is 20,000. So what is the contract profit? 50,000, because 130 plus 20 is 150 and minus 200 is 50,000. Step number 2, stage of completion. Work certified to date divide by total contract. So 180 divide by 200. It's 90%. 90% contract has been completed. Now the step number 3, revenue. Revenue is how much? 200,000 into 90%. So multiply by 200,000. It's 1,80,000. All right. And then we have the profit. How much is the total profit? 50,000 multiply by 90%. That means 45,000. The cost will be as a balancing figure. They have told us that 15,000 of this revenue has been recorded in the previous year. That means 31st May 2003. And now they are asking what will be recorded in this year, 31st May 2004. So 45,000 minus 15,000, because this has already been recorded. So 30,000 is the profit which will be recorded in the current year. All right, the last example which we are doing is Hindberg is a car retailer. On 1st April 2004, Hindberg sold a car to Latterley on the following terms. The selling price of the car was 25,300. Latterley paid 12650 on 1st April 2004, that means on the same day, and will pay the remaining 12,650, which is a half payment, after 2 years. So we know that IFRS 15 says regarding the financing component that you have to calculate the present value. Latterly can obtain finance at a 10%, so this is the discount rate which has already been given. What is the total amount which Hindberg should credit to the profit or loss in respect of this transaction in the year ended 31st March 2005? So the revenue they can immediately record is 12,650. 12,650. And now we need to plus the other revenue. which should be discounted. So present value equals 12650, sorry, 12650, 1 plus r raised to power minus 2, because they will be giving after 2 years. Let me calculate it. 1 plus 0.1 raised to power minus 2 raised to power minus 2. All right. Multiply by 12650. All right. So it is, yes. All right. So it is 10,454. So the present value is 10,454. But they are asking what revenue they should record in the 31st March 20x5. So by 31st March 20x5, there will be only 1 year left. So that means we'll be taking 1 year discount factor. So 0.1 raised to power minus 1, okay, multiply by 12650. It is 11,500. 11,500. So 12650 plus 11,500 is 24,150. These the option. Or the other way which you can do is, now you can add 10% in it. You can add 10% in it to do the unwinding, and then you will get the similar answer. So either you can take 1 year discount factor, or you can do unwinding after the calculation of the present value. Both will give you the same answer. So this is how you are going to deal with IFRS 15 in the exam. I hope you have understood each and everything of the standard.